Welcome to the podcast and video. I'm joined by Paul Hill, of course, full-time investor, equity analyst, exudes such professionalism. Even I wear a shirt when I talk to him. That's the kind of professional he exudes there. And
yeah, you look very smart, and I appreciate it there, Justin. Now, actually, can we just turn the clock back? Because I know we chatted about it, a couple of things right at the end of 2 weeks ago. The first, actually, was I did actually predict that Merck would come out with a blockbuster antiviral.
Oh, yeah.
And within about 2 hours of publishing, they did, which is a bit faster than I did. So I think that's a backdrop that we can almost put. I mean, I don't want to be tempting fate, but almost put COVID to bed now, because we've got sort of like brilliant testing, we've got fantastic vaccines, and now the last sort of like leg in the stool, three-legged stool, was actually an antiviral, and we do have that now.
Explain what antivirals do for people not familiar. Of course, we all understand what vaccines do now. We all understand what testing does, but antiviral, for people not familiar, what does that do?
Basically, what it basically means is if you contract COVID and you haven't actually responded very well to the vaccines, i.e. you haven't built up great resistance in terms of antibodies, then you'll still suffer considerably from the symptoms, and you may or may not go into hospital. Let's just assume you're one of the 3% globally, which is about, sort of 250 million people who have compromised immune systems. And therefore, when you are vaccinated, then you're not going to have an immune response, which is going to create the necessary protection from antibodies. Therefore, you are very susceptible to go into hospitalization and cause a burden on all the healthcare systems around the world. Therefore, if you do rock up into hospital, then an antiviral will, instead of dying, you'll basically, one, hopefully survive, and two, and importantly for the healthcare, on the hospitals and stuff, is recover a lot faster than you would have done previously. So consequently, it's going to alleviate the pressure on the healthcare services and reduce the fatality rate. So that is why an antiviral is so important. And they came out with basically, I think it's called Molnupiravir, which is basically, and they've got blockbuster orders already, because the US government's already pitched in with $1.6 billion worth of ordering, and other governments around the world are also doing that once it gets approved. So
Merck the only one so it was FDA approved, was it?
No. It's just okay. They've applied for emergency authorization of it, and subject to that, but it actually has. It's obviously passed on its phase 3 double-blind trials and done really well. And there's so much interest around the world, but it isn't just that one. I mean, I was one of the reasons why I invested in Merck, and the other company is Gilead, which is also doing a tablet for remdesivir, which could also be approved, sort of like Q1 next year. And the other people in this antiviral space are Roche, who have got a tablet coming out, and that may come through clinical trials, phase 3 by the end of the year. So we'll have a sort of like a whole lot of them. And the other healthcare company I own, which is AstraZeneca, which is massive, obviously, into oncology, i.e. cancer-wise, they've came out with some very encouraging phase 3 data for their antibody cocktail, and the reason why that is so important, it's the first one which is long acting, i.e. long lasting for patients, greater long length of protection, but also can be injected rather than intravenously dripped in, because all the other ones you have to go into hospital and then be put in for these antibodies. This is the first one you can actually just be like given a shot as you do for vaccine. So the world is becoming far more resilient now and knows a lot more about COVID, and I actually do think it's got the tools to get through it. So unless we get a really, really nasty variant that can sidestep the vaccines, the efficacy of the vaccines, then I think we've seen the worst of it.
So which one do you own? Is it Merck or Gilead?
I own Merck, Gilead, and AstraZeneca.
Okay. Did the SP react positively to that?
Yeah. Okay. It went up about 10%. Yeah. I mean, it's come down because obviously we've had quite a bit of a sell-off recently, but I mean, I bought it for the long term. Merck, I mean, the reason why I bought Merck was because it's massive into oncology, into immunotherapies. The same logic for AstraZeneca as well. And Gilead are just best in class in terms of the whole antiviral space, particularly in HIV and hepatitis C, and they're actually pretty big now, getting into oncology as well, immunotherapies.
Yeah.
So.
I don't know if you noticed that when I said the word 3 letters FDA, I had a very bitter taste in my mouth.
Yeah, well, that was what I was going to go on next. The other big news was going to be Polarean. So now you've had a chance. It's sort of like 2 weeks on, or 10 days on from the big sort of news where it was. I mean, I would say, just as an observer, because I don't own shares, okay, this was a really sort of like, low probability risk which was going to happen, and it did actually happen. So, I mean, that's all that
exactly. I was chatting to Vadim, as head of healthcare, to one of the brokers there, and he also holds. And he said, listen, once you go through, they did 2 phase 3 trials, of course, passed, and all that. So it's pretty much low risk when it gets to that stage. It should be almost like a rubber stamping exercise. That's why it's 90%. It comes down to, and the thing that compounded the fall here was everyone was waiting for the results. I mean, it was October the 5th, of course, was the date. But of course, with the time zone differences, people thought, okay, maybe the RNS would come out at 7 a.m. On the 6th of October. It didn't come out. So most of the way through the day, it didn't come out. And so normally when an RNS comes out at 7 a.m., you can digest that, you can read it before the market's open. Trouble is, they released this at 2:30 or something in the afternoon. Markets are open, and what we were expecting to see was FDA approval. What we saw was CRL, complete response letter. Oh, hang on a sec. So people just hit sell straight away. And I thought, I opened the email and I said, is there an acceptance in there, but with conditions? No, there wasn't. So that was a bit worrying. People just hit the sell button. It dropped like 60% or something. It went up 35 pence from like 90 pence. It's bounced back now to 75 pence. But but a lot of things are chiming now. They said it's manufacturing. Apparently, when you look into it, this is why I like investing. You learn more and more. And people point out CRLs are not the same. You got to look at them. If the issue is with the safety and efficacy of the clinical trials, is a big problem. Probably costs a lot of money, a lot of time. If it's with manufacturing, then it's not so bad. It could be quite a quick fix. I would say quick fix, 12 months or less. But it looks like that's the case, because I went into their financial results, and they had taken on an extra manufacturer in addition to the previous manufacturer. And I think there's a previous manufacturer's data they'd supplied to the FDA. And now the FDA want to know what the new manufacturer is. That the same as, can they produce machines exactly the same as the other one? So that's the sticking point. So it seems like a quick fix. I know Richard, CEO and non-executive director and the chairman bought in on the dip. So
I saw that was obviously confidence building.
Yeah. And Bracco, the NED guy, Cyril Petit, his name is Petit. He's also, a big guy in Bracco. Bracco Imaging is one of the biggest imaging. So they're a large shareholder of Polarean as well, so they have confidence. So I think I said at the time, the things that's changed here, time to market. The things that haven't changed is potential. But so if you're patient, it's awful when that happens. You see a share price drop that big, and it scares the living heck out of you. But I know some people bought the dip there, and they're laughing now. They've 100% from
that. 72p this morning, isn't it? I just see. So I mean, when you sort of like look at it big picture wise, are there any sort of like lessons you learn from an investor? Because obviously we both operate pretty concentrated, high conviction portfolios, but you more so than I do. You have less stocks. I mean, I have 5 stocks, and this is so this is basically, I don't know, do the maths, 20% of your portfolio, isn't it?
Yeah. So that 50% drop, that will knock about 10%, and but the lesson I learned from this is, even when you have a binary play, first of all, try and avoid binary plays, if unless they're very odds on, a high chance of probability. Even then, it's not nailed on. So if I'd adjust your risk, appropriately.
Okay, can I just ask one question? How do you measure risk? Okay.
Well, in that case, I just went with, I got the broken out, for example, a 90% chance of success. But do you know what? At the end of the day, it's a binary play. Your commercial success is based on a regulatory body. That's very unpredictable. Like I said, and we've just seen this, evidence of this. So
can I just suggest then, okay, just for investors, this is a broader issue, okay? If you want to sort of quantify, and I'm a numbers man, if you want to quantify risk, okay, it has two components. First of all is probability of the outcome of the worst case. And the second is materiality. If it happens, how painful is it going to be? So let's just assume for this one, let's just run that example. Probability of this occurring, i.e. of a non-compliance letter, was 10% because it was 90% probable that it was gonna get approved. So it was 10% probability. What was the materiality? Okay, materiality actually is that it cut the shares in half. Yeah. Now, so if you add those two, if you times those two together, you get what, effectively. So let's just hypothetically say, and I don't know, but let's just say you had £1 million worth of Polarean shares. It dropped by 50%, so that's £500,000, yeah? And the probability was 10%. So effectively, if you're going to try and quantify that on a probability weighted risk, then that was going to be 50 grand. That was effectively into what you're going to do. But your worst case was you were going to drop £500,000. Then there's a question you've got to ask yourself: was that if that occurs, how can I get through it? And am I prepared to wait through it? And if the answer to those two is tick, then you can basically go forward. But if it isn't, then that's the time you should basically take a bit of profit off the table or take some weight off the table. If you're coming up to a binary event.
That's exactly what I was saying. I've done this with like I said, the reason why I hold 5 stocks is I'm quite happy with the risk and reward profile of that. I mean, if you're all looking, like you said, equally weighted stocks, so say 20% each, a 50% drop takes 10% off your portfolio value. If you're not happy with that, you can less than that. Like I said, bring it down to 10%, and that would be a 5% hit. Because I saw this hit going 50% drop. You'll always get, even with oil and gas and anything like that, any dusters like that, you'll get a 50% drop when it's not expected. And this is the same. I saw it went down 60%, but it bounced back up. But I mean, I already thought this is going to drop by 50% if you don't get the intended, the result you expect. So if you got, like I said, if you allocate 10% of your portfolio value to that stock, that will be a 5% hit overall total, pretty much everything else been equal. So yeah, that's the way. I mean, I just look at it in percentages like that. And I got a little spreadsheet, and I should have. And now, when it comes to a binary plate, and I said I'll do this again, I'll take some off before the next FDA approval because I don't care, and I even don't care what the brokers are saying anymore or anyone saying. I'll say there's always that chance it could happen, so be prepared for that. And
would you?
It's never nailed on,
Okay, so first lesson for investors, broad issue, is if you want to quantify risk, it's probability and materiality, and do that in your own mind about how painful it would be. And if it isn't, then reduce your exposure. Second question, you just said to me, you would, for the rest of your portfolio, you would look at it. Now, let's just assume you have 20, another 20% in each, stock, of weighting on your portfolio. Like Escapement, I know you've got a big position in Escapement. So will you reduce some of your exposure there, or are you going to still run it 20-25% on your other stocks?
Because this is a different play for me. I mean, generally every other stock I've got is generating revenue. They're heading towards profitability. They don't have these, binary results or events that's coming up. They don't have that. They just, for example, Escapement. All they need to do is open good sites in good locations. Now the door is open for them there. They're pushing an open door because there's plenty of commercial managers who want them at their sites. Where's the regulatory risk there, or the binary outplay there, or even with Gfinity, signing with big brands? So they are now. Polarean never really fit my strategy, but I like the story so much I wanted some of it, and I always knew it was the riskiest, and of course it was the highest market cap I got as well. So it was always the riskiest, and maybe I should have taken. And next time, if I see a story like this, I'm not going to avoid it completely, but I'm going to be more aware of these. These binary decisions can impact massively, and so, like I say, de-risk beforehand, because the share price rose to £100, £1.10. And I've owned this since it was 17 pence, and so I've got plenty of profit in there. I did average up a little bit, and in fact, to the point where when it hit 35 pence, I was actually underwater a little bit. So that was my average for 35. So yeah, I had plenty of profit in there. I should have taken some off because it was a binary outcome. And even
so just coming back to that sort of like just for investors on a broad issue. So you're happy then having a weighting in a stock of 20-25% of your portfolio with 5 stocks. I mean,
yeah.
Okay, because that is
but
all I would say, that is a really high risk strategy.
Yeah, no, absolutely it is. Yeah, high risk, high reward. Well, it's why I've done sort of close to 8,000% in the last 10 years. It's because I do play high risk, but it's knowing the risk. I said that was the highest risk stock I've ever held. I've held, a long-term hold. So I knew it was high risk. What I didn't do was play the binary outcome. I was most investors, I think, were just convinced that it was such a nailed-on thing. They didn't actually pay any attention to that risk whatsoever. Should have.
Yes. So which stocks do you own then? So effectively, you've got Biome Tech. Is that right?
Biome Technology, Gfinity, Escapement, and Trufin. In fact, news on Trufin this week as well.
Didn't you have iNexus at some point?
No, I'm out. In fact,
you're out. Okay.
Yeah.
Okay, fine. Okay, so
in fact, I've got two other tiddlers. I've got a little bit in, which I'm looking at. I like, but they're again now probably a knee-jerk reaction. They are very safe. They got lots of cash. They're generating revenue. And in fact, stocks I invest in generally fit that safe element. Really, they've got a lot of cash. They're heading towards profitability, or they're there pretty much. Like I said, Polarean was an outlier, pretty much. Risk for. I mean, I never get involved in clinical trials companies or oil and gas drills, any of that binary outcome plays, high risk. So I never do that. I mean, of course, it's the high risk, high reward, but within that area, of small micro caps, you can find, safer plays.
So which toehold positions have you got in those other 2 companies? What are they?
I'm not saying that yet, because what happens? They're small caps, and people will sort of buy them and stuff. And I know I'm convinced myself. I like them, and the reason why I buy a little toehold is because I tend to pay more attention to research them more. Because there's so many companies on my watch list. If I don't have anything in them, I'll think. But literally 2 companies. But I like the areas they're in, but I've got to be a bit more convinced, and I'll pay more attention to them. Once they get to that level with their conviction, and I feel confident, I'll share them a little bit, But yeah.
All I would say from a risk perspective, I mean, you got Biome Tech, which is a 15 million market cap company. Gfinity's 55. What else we got? Polarean 150 mil, which is fine. Trufin's 50 mil. Have you got any others? Did you say? No. Escapement, 30. 30 what? Yeah. Or anything less than 50 million is high risk. And I would. And Biome Tech at 15 million definitely is the higher level. So if you're at 20% exposure on your portfolio, if investors are running those, all I would say for that, you've got to be young, and you've got to be meat-eating, testosterone.
That's me.
Okay, yeah.
Well, I'm not young. I don't eat meat, so there we are. Out of those 2. No, but listen. What I'm saying is, I've seen big companies, halve, and they've got plenty of cash, and they're doing well. Look at the banks, for example. Look at in fact, look at Boohoo right now. It's done over a 30% drop in the last few. So there's no safe share price wise company. I see them all, big companies, small companies. I've been for over 20 years. I've held big companies, small companies. I've taken big knocks on big companies. Now, if you can weigh up, I've got a 9-point strategy that I look at every time. And if you weigh that up and you go through that, and I'm looking at literally very little cash burn, decent amount of cash to get the profitability if they're not there, in hot areas, generating revenue, the valuation is good, all that stuff. If you weigh that up, then you can reduce the risk, but the reward can be still very, very high. The only problem is liquidity in those areas. But listen, big companies, take big knocks. I've been in them, and I've experienced it. Thinking, hang on, this is supposed to be a blue chip, big safe company. So it's all about looking at businesses and weighing up the risk. What's the big risk here? What's the outside left field thing that can happen? And the more you get to know them, the more you can evaluate that. And so I just think, like Warren Buffett, I mean, he talks about big companies generating a lot of cash flow, I know, but people tend to add companies without doing lots of research on them. You're better off, I believe, doing lots of research on a few companies and getting them very well, rather than having lots of companies you know nothing about, because basically just you are the market then. And so yeah, I mean, I'll spend lots of time on each company, and I can scale in for ages, and I'll scale back out when I'm happy with the company. But yeah, I mean, of course they're risks, but they're high reward. But
yeah, I mean, all I would say is that don't ignore, because we both operate high conviction portfolios, which each of those stocks has basically a lot of idiosyncratic risk, i.e. individual risk. However, if you operate in the very micro area of the stocks, then it isn't just idiosyncratic risk, it's also micro cap risk. And so you can get scenarios whereby they are actually linked. They're not effectively mutually exclusive, those stocks, i.e. if you get a sell-off in micro caps, small caps, etc., it hits that part even worse. Now,
it's happened this summer.
Exactly.
This summer,
So if you have a very, very long-term time horizon and an asbestos suit, then you can get through it, not a problem. But all I would say is that just think top level in terms of portfolio construction. Are these mutually exclusive really, or actually is there an overlaying risk in that real micro area? And also, when you come to measure risk, measure it in terms of the portfolio side, top level, but likewise at an individual level in terms of materiality and probability. I think those are really two quite good lessons when you operate in our area, because I mean, I've got my portfolio is that, I'm happy to hold a few sort of like high octane micro stuff. But frankly, when it comes to sort of like getting in and getting out in terms of liquidity, I can't get in and I can't get out anyway.
No, I know that's the issue I have. I mean, I know that. But do you know what? I mean, I genuinely got to invest in businesses that I find quite exciting and I like. Now, if I'm going to just diversify for the sake of it into bigger companies, I'll just buy a fund, and I'll be done with that. So because
you'll never buy a fund, you'll never buy a fund, just because
I buy a fund and get bored with it.
Exactly, because it isn't fun.
No. Okay, well, it's the fun from the word fund.
Exactly. Yeah. I think we've come through some really good.
No, listen. Yeah, no, listen. I can be saying I to my share picking investment club there. I often punch out this spreadsheet of risk reward there, and I said depends what your tolerance for risk and reward is. If you're happy to take a big hit, if you want to own one stock, you've got to be prepared to take drawdowns of like 50-60%. Now that's ridiculous. I couldn't do that. Again, I'm not happy with the reward sort of 20-30 stocks give me. So I have to be a bit more concentrated, but it's all about that. It's like, can you stomach that? I mean, even Buffett said, if you can't take a 50% drop on one stock, then we probably should be investing in a high conviction play. That's the way it goes. That's the way it goes. It's all about, can you? I know some people, they panic every day when they see a stock go down by 2-3%. I think, oh, you shouldn't be in this game. Just get a fund. It's
and I would say you only know your risk tolerance when you blast through, when it happens.
Yeah, that Polarean was scary. It was like, wow. Even when before I'd finished reading the RNS, it was down like 50%. 42%, maybe 42%, 50%. Go. And when you get a decent chunk of cash in there, you get, oh, good. But I didn't sell anything. I thought, listen, the more I read that RNS, the more I think, hang on a sec, they're saying it's not this. And then you do more research. And I think one of the things is time the market. Don't panic sell, don't panic buy. Those are extreme emotions. If you act on extreme emotions, you're not going to do very well in the markets, because you often have days where that was Brown Wednesdays. Well, last Wednesday was dreadful for the entire market. Then that came out. Then wow, why not release bad news on a bad day? Go for it. And so yeah, but if you can't take that kind of volatility, either diversify more or just get a fund, and because it's painful.
Well, just now moving on to let's move on to sort of the housing market, because I know you touched base with was it Jason Tebb and
Jason and Clive? Yeah, Jason Clive.
Yeah, Jason. Clive Beattie, the CFO at OnTheMarket, because that's really. There's some really interesting read acrosses there in terms of, because they're in the consumer sector for obviously purchasing houses, and obviously in the housing market, and both of those sectors have been really badly hit of late, and are throwing up some quite good opportunities in terms of stocks. So just quickly run through what they told you on the call.
Yeah, well, I liked OnTheMarket for a long time. Compared to the valuations of Rightmove, I know Rightmove is the top dog, the head operator, and you always get a premium for that. But also the margins are amazing, chucking off. But there's growth here. If you look at these companies this size, you look for growth, and valuation. And if you look at The group revenue went up by 46% to 14.9 million, from 10.2. Adjusted profit up 163% to 2.1. So, the cash went down a little bit, 7%, but they are spending a lot on tech and enabling that and be a bit smarter about it, not just trying to take, Rightmove head on. They are getting a lot more sticky in their tech, and they get offering a lot more to their clients. So, and genuinely, they're doing a good job, I think. And like I said, it's been growing now for a while, and I think it's headed in the right direction. And I just get the feeling from Clive and Jason, they're happy with how things are going. He's been 9 months in the job, Jason, and Clive was the CEO before that, did a good job. And so I think as a pair, they're doing very well. I can sense a bit of optimism there. But they did say, the market there, we've had this, since COVID, people want to move out of the cities, people are trying to buy houses, houses were put up for sale in the morning, to be gone before late morning. Is that cooled down a bit? It has a bit, and the rates do, it has a bit, but it's still very busy because there's lack of supply, so people were checking our website all the time. There's demand.
Let's just jump on that one, because that's what I thought was a couple of things which I thought were absolutely brilliant. Was one, if you actually strip out the incentive changes they've done between last year and this year, underlying revenue was up 24%, and like for like, effectively ARPU, or average revenue per advertiser, was up 28%, which is really at the essence of the business. They're delivering higher added value services, which is allowing them to effectively to give a full price service to their advertisers, and they're getting benefits. So that whole strategic direction for the business is really working. But the other thing, which was a massive read across, which I felt was fascinating from your interview, was actually this, as you rightly say, the level of housing stock coming on the market, and even letting stock coming on the market, is a lot lower. Now, when you think about that, okay, it might mean that we're just deferring revenue from the market, but let's just look at the sort of like a broader housing market. If you've got a restricted supply and still massive pent-up demand to buy property, because let's be clear about it, people have been locked up for 18 months with their parents and want to either move out to let it, to rent a place into a centre, or into city centre, or buy a place of their own as a first-time buyer, then you've still got that huge number of people who are fed up with their parents and basically want to get out, and there isn't enough supply coming on. So what does that mean? Well, it means that house prices, are not going down anytime soon, and that's why you see, in terms of the Halifax, talking about high single-digit, like-for-like prices. Now, also, what does that mean as a read across to the consumer? Okay, and if you've got your house price increasing, the wealth effect for homeowners around the UK is going to continue. People are going to still basically be making probably more money on their house than they probably are from their from working, and therefore they're going to feel wealthy. They're going to want to spend. They want to go on foreign holidays, and you've seen that just through the bookings through from half term. So it's got the reason why I think the on the market was really interesting. Not only that the business is flying and doing really well, and strategically looks very, very cheap, but also has a lot of read across into the health of the consumer and the health of the housing market as well.
Yeah, but you know what's it's interesting. I think that the fact is, if you look at the advertisers, they're not that far off from Rightmove. I mean, they've got about 13, close to 14,000. Rightmove got 19,000. The difference is in the price they charge those, and a lot of those, like I say, were in introductory contracts. And that's slowly now starting to churn. They're starting to say to people, okay, you've come to the end of your introductory contract now, you're off, unless you pay. And now Jason said people are starting to see that they are getting real value with us, because like I said, they're charging $188 pretty much per month. And Rightmove like 8 times more than that. And yet the traffic, I mean, okay, is a bit different, but you're not getting 8 times as much traffic into Rightmove and all that, and 8 times as much leads. So it doesn't really cross. So yeah, people are seeing the value on the market, and they're starting to do that. So now we're converting a lot more people. So all they have to do is bring that 188 quid a month, halfway up, a little bit more up, and that will make material gains. That's all they have to do. So they don't have to keep winning new people. They just have to convert the ones they've got. You know, the low.
And I think they do have some real differentiators, USPs. I think that new and exclusive 24-hour offer has actually gone down very well, hasn't it? With sort of
I kept saying that when Clive was here. I said, do you know what the reason why I got the OnTheMarket app? I was in my car and I heard that advert saying we get, properties, especially now, like there's lack of supply. We get properties online 24 hours exclusively before any other portal, and that's why I download the app. And you get that, and I get notifications. I always keep an eye on all the houses. But yeah, that is the thing, isn't it? You want to get a viewing ahead of anyone else, because if you like it, because you've looked at all the things on there already on the site. Okay, not quite fitting my criteria. A new one comes on. Oh, right, book a viewing, put an offer down before anyone else. Because at the moment, people are making offers, seeing houses they were a while back. They're not even seeing it. I'll make an offer. That's how crazy the market was getting,
And the other thing which is playing effect into this sort of is a factor to sort of like weigh in, and it's difficult to actually put a quantification on it. But let's just say, you're not dissimilar to a lot of other people. You've had a few diggers in your house, and you've had a home office put in, and you've done your drive and all this sort of stuff. And so consequently last year during the lockdowns, and even currently there's still plenty happening, you've decided to upgrade your house. You've done a lot of repair, maintenance, and installation, etc. of your property. Well, frankly, it probably means you're going to be you want to enjoy it a bit before you put your house on the market, or if you maybe still doing all those repairs, putting on a new roof and this sort of stuff. And on that basis, the supply of new housing stock is unlikely to alleviate in the next sort of like 2 or 3 months. It probably will next year as these things roll off. But what that means is it's still going to be a very tight market going forward. And that's largely because of, say, you've got people basically who, like you, have done their own home repairs and put a home office in, and then want to enjoy it before they decide to upgrade, or may even decide they don't need to upgrade now. And therefore this pent up demand could last a lot longer than people think. And I think this whole wealth effect is a really big factor that's not being pushed into the housing market and into the consumer market. So let's just take the rest of the broader housing market. What did Barratt Development say this week? They're seeing incredible. They're actually seeing 4 to 5% price input price inflation, i.e., supply chain and stuff like that. And I know we're going to come on to that later, but they are more than absorbing that through their price increases, house price increases, because they can. And they're pushing that forward. I mean, with 10% to go. And also what that means, is if you haven't got a big supply of new houses, which is, again, think about that as an investor, as a read across, it means that not only house prices are going up, it's going to be a great time to be a new house builder. If you're a new build house, builder, and you've got 5,000 houses coming on over the next in a number of different sites, then frankly, you're pre-selling that dead easy, because people want to buy it, because there aren't the much bigger market. There's about 1.2 million houses bought each year in the UK, of which about 200,000, 250,000 are new build. Now, if that existing housing stock is not coming on, which is like, effectively over 80% of that of the purchase is not increasing, and has decreased, it means the demand for new builds even higher. So if you're a house builder, which is like Barratt Developments, you're having an absolute laugh. And what that also means is that you look at the ecosystem, and there's value in house builders now because they've come off. And if you also look at the ecosystem into building products, and I would point out people, my favorite is people like, Michelmersh, who have really strong differentiated brand. They make premium bricks, which go into sort of like, prestige houses and repair and maintenance properties. And their shares have come down to about 120, 125. And I think I think they're really, really good value now, from about 150, 160. And then you've got to ask yourself, why is that happening? Well, it's fear about the housing market. Is it slowing down? I just don't think it is. And I think that's mispriced in the whole sector. And then you've got to ask yourself, okay, they're a brick manufacturer. Are their input cost inflation going up? Yes, they are exposed more than most to energy prices and that fear about the whole gas and electricity going up. But Michelmersh I know the guys, and they are super prudent, and I bet they've basically hedged off that in that electricity and gas bill for quite some time going forward. And I just don't. I think their profits are going to be very much underpinned because they're going to get firm pricing on their bricks because new build's going to stay firm, and repair and maintenance is going to stay firm as well. So I think there's some good value in there, even though the market has treated essentially all builders and all building products companies equally, i.e., should have sold them off. So there's good value in on the market, and I think there's good value in some of the house builders. And I'll point investors, have a good look at Michelmersh because last time I did the numbers, it's trading at less than 8 times EBITDA. And it should trade easily, probably about 10 times EBITDA. So I think this is 20% undervalued.
Yeah. It's a good stat. I looked at this just now because you mentioned the value in house price and wealth, that wealth factor. So the average house price in the UK is 250 grand, right? Obviously we're having a bit of a bumper year, but 13% growth in house prices. That if you work that out, that's £32,000. That's more than the national average wage. So your value of your house is got by your national average rate, more than that. So that's amazing, isn't it? The wealth of that. So if you're on national average wage, you're doing 31,000. So your house, if you own a 250 grand house, is now earning more than you. So it's amazing stats. Yeah, and
another one just to complete that housing sort of like circle, etc. Is that one of the other stocks I own, which is effectively a quasi bond, inflation play, is Grainger, which is the UK's largest private rental landlord, and it came out with a fabulous trading update. I mean, it's seeing occupancy rates now go back to pre-pandemic levels. It said, the CEO said that it had a really, really strong September lettings as people are just effectively descending back into the cities and renting new property because they're sick to death with living there with their parents or living with, in a little hole outside. They're just bored. They want to get back in. And so that whole rental sector is now catching up with house prices because you're seeing increases in rental values, which will boost their property portfolio. And you're also seeing greater income in terms of the premiums people can charge. I mean, there's a massive, obviously, everybody knows it's more expensive to rent a property in the private sector in London than anywhere else in the country. But you're starting to see London come back, and their new build, their rent to build properties, which are effectively purpose built, sort of like apartments with all the sort of like bells and whistles and nice refineries, refinements and sort of like concierge and air conditioning and gyms and this sort of stuff. I mean, they're well ahead of expectations. So this one's coming back really, really well. And the CEO, Helen Gordon, says that, she's seeing some fantastic investment opportunities. And I am as well, in terms of not just Grainger, but elsewhere across that property. So across the property and house building and that whole ecosystem. And likewise in the consumer sector, because I think the market's got it wrong in terms of pricing in this, basically in the negativity.
Yeah, let's talk about that inflation. At what level? Because there's been this talk about transitory, but we're seeing all these containers now parking outside ports. And I think at what level though does house prices get to the point where people just I can't afford that, and it incurs a slump? Or will there always be a market for that, or do prices have to adjust? Because house prices very rarely come down, do they? But also just looking at the Christmas aspect and more tangible items and presents and all that stuff. Of course, you're going to get a run up here because people are buying more than they normally do because it's Christmas. But after Christmas, surely the supply chain issue will ease, won't it, in certain areas?
It is already. I mean, if you actually look at the freight rates, from China to America and to Europe, it's topped out and has started to come down. I mean, there was quite a good article actually in the FT today, and it just shows you it reached a peak in round about sort of like early September, and has actually come down in a lot of places. So a lot of the ports, yes, they're stacked up with ships and freight containers outside, but actually it's getting better. Felixstowe maybe slightly less, but it is reducing. I mean, it's still coming from high elevated levels, but actually, I'm with you. We're gonna when we get to next year, we'll see this one resolve because if you resolve the pandemic and then it allows more people to go and work into ports and to become HGV drivers, and we're not closing sort of like, bottleneck areas. And you'll see that, alleviated. So when you come back to your question in terms of inflation, okay, what investors should think about is how it's actually going to impact the consumer, the person who's going to buy, say, houses and activities. Well, if their wages are going up by at least inflation, in fact, it's going up currently more than inflation, they're getting a real positive shift on their real salaries. So on that basis, then they're quids in. In my view, for the health of the consumer, anybody in work, which is roughly around about 30 million people, is fine, because it's at record levels. We got those figures last week. They're fine. They're still earning well, so they'll be able to absorb the inflation. If they've got a greater money coming in, they'll be able to afford houses, because the affordability will be fine as well. The real issue is the unfortunate 5 million who are in universal credit. Now, if you're on a universal credit, and actually there's about 5 million people in the UK who are on it, and there's about 5 million social houses as well, supplied by the local council and housing association. So it sort of like fits quite well in that respect. So there is going to be a polarization of the consumer. At the lower level, with higher inflation, it's going to be really, really tough. So if you haven't got a job, and there's about 1 million vacancies, but if you haven't got a job and because you can't work, for instance, then yeah, you're really going to struggle, particularly as the government has just removed the £20 per week extra benefit that they put in for the pandemic. I actually think in this instance, if there is a problem, the government will dip into its pocket and help these guys out and put in another sort of pandemic relief, just get them through the energy crisis, because they will be struggling. But if you're in work, if you're one of the working, 30 million, I think you're going to do fine, because your real wages are going up, obviously in real terms. So I don't think that's going to be a major issue.
Yeah, and like you said, the restocking, I think that'll happen. Post Christmas, you have oversupply of goods then, and that'll bring it all.
I'll tell you, the restocking will be a massive boost to global GDP for next year. So that cool. should be a real tailwind.
Right. Any other companies?
Yeah. Well, another one.
Avingtrans. You mentioned those because the guy,
Steve McQuillan, CEO.
Steve McQuillan, yeah, lovely guy, really nice, and I didn't realize he's taking a holiday in a little island in France, but he's a lovely guy. But if you just all I say to is, look at the share price of this company, and you realize they're doing something right there. And if you look at it, to explain it, you're better off explaining it. But I just like where they're at. Highly regulated sort of engineering markets on there that, very little competition, I suppose. But and it sticks in my mind is that nuclear, sort of protector box they make. There's 500 years. So that's amazing. That kind of bomb-proof.
Safety box for medium level nuclear waste out of Sellafield. They're about the size. They're 3 meters by 3 meters, so about the size of the average family car. Yeah, and they're designed to last 500 years. That you put it underground to store, medium level nuclear waste, and they're selling about 1,000 of these extra now to Sellafield. They've got a 70 million contract, but frankly, this is just a drop in the ocean. If you actually look at
this is the kind of company that doesn't get affected by inflation. This is the kind of company.
Yeah, exactly.
Literally, they're so far removed from any of that macro. It doesn't matter. These are critically, sustainable.
Yeah. So they've got basically they've sold about they've had a 70 million sort of contract over multiple years, etc. with Sellafield. But if you actually look at it, okay, here's a question for you: how long does the experts reckon it's going to take to decommission the existing older nuclear stock in the UK? Just give us a figure.
Well, how many?
How long is it going to take? Yeah.
25 years.
About 120 years. And how much? And how much is it going to cost?
Oh, I have no idea.
130 billion pounds. Wow. Okay.
That's long-term contracts right there.
Sellafield, exactly. Sellafield are one of the world's top-rated experts in decommissioning anywhere on the globe. Okay, they are effectively a centre of excellence, a cluster of just total of expertise. Yeah, they have Avingtrans' Metalcraft division, which supplies these nuclear decommissioning, is absolutely well integrated into Sellafield, and therefore is in a great position, not only with Sellafield, with that enormous mountain of spend coming down the track, but also across the world. But that isn't just what they do as well. They also do these blast-proof doors, as you say, for the likes of HS2, also for submarines and other really hazardous areas like nuclear facilities. And then they do really high performance and, you know, pumps and motors for other facilities in highly regulated areas and stuff for power and energy and stuff like that. So they are, as you rightly say, they are really niche, very highly differentiated, where there is pricing power, and they buy a business they can turn around, and they're flush with cash. And their big news they had this week was that because that's their main body of their industry, but their activities. But they've also got another medical business called Magnetica, where they own a 58% stake in it, which is doing a small form cryogen-free MRI scanner. And they've basically just bought Avingtrans at the group level, I think it was a 5.9% stake for £2.5 million in a Oxford-based company called Adaptix, which is doing a similar small form 3D low dose, low cost X-ray machine, which is just on the road now, just starting commercialization, which is slightly ahead of Magnetica's MRI, which does the soft tissue. The X-ray does the skeleton side. And the big sort of idea there is twofold. One, it will help accelerate the commercialization and development of Magnetica's own MRI scanner, but ultimately to be able to fuse those two images together, the X-ray skeletal with the soft tissue MRI, and just think the benefits of that. How many people go to a doctor with a broken bone and then have to have an X-ray first, and then have to have an MRI or a CT scan because you need more detail, and that'll be all done in one shot. So that could be a huge sort of like step change in functionality in the orthopedics, is where this will be really beneficial, but also in, you know, veterinarian and maybe even the neonatal side ultimately. And I think they're also thinking about putting in at the end of the day, you know, putting in what's it called, ultra, basically the other ones where they do for pregnant women. I can't remember the other scan.
Yeah, ultrasound and all that stuff.
Ultrasound, that's it. I was trying to find the word. Yeah, so it's a really, really smart deal. £2.5 million, and it's again bringing two best-in-class technologies together in a small form sort of image scanner type market, which can be done at the point of care, importantly, rather than having to rock up in hospital into a radiology department where it removes the resource, it alleviates the resource on hospitals as well. So yeah, really, I mean, they're basically, that management team is really smart. The shares have gone up more than 20% per annum compound over the last decade.
The only worry about that business is where do I enter here? Because the share price keeps going up, and you think it's got to come back sooner or later. And there's very few times it does come back. Look at the chart.
I know, yeah. Well, when I did start talking about it, I did mention that Christopher Mills, a really smart investor, went in at about 250, 260. And I did say, well, this guy knows his onions, so he hasn't done that for no reason.
Talking about smart investors that you've talked to through these guys, actually, by the way, one of the companies I own, Trufin, one of the issues that people had with this was Arrowgrass, which was a fund that's now closed, held 73%. They placed sort of 50% of the shares a few months back, and then so it's 20% left. And so people say, oh, well, they just drop this in the market. They won't drop it in the market. It'll be done the same as previously because they can't. And some of the guys had taken up those Arrowgrass shares. Gresham House, they've upped their holding to 10.3%. Lombard up their holding to 6.7%. Or else their Crux Asset Management up their holding to 3%. Also, Jupiter Asset Management 5%. So they're taking some decent funds there, taking some of Trufin, the Arrowgrass fund shares, and there's some more to come on board because there's still a few shares left. But that's quite encouraging, I suppose, isn't it?
And just rounding off the consumer side of it. Yeah. Now, I know you spoke to the CEO, Suk Chamdal, and the CFO, Pardip Das of Catebox. I tell you, was their trading update good or what? I mean, flipping out, their sales were up. We're up the store ones 13% like for like, which was obviously a cracking result. But what does that actually mean for their franchise capital light model? Well, it meant that their actual revenues were up over pre-pandemic levels. So this is before the pandemic. They were up 87%. I mean, that business is absolutely flying at the moment. It's healthy cash reserves, and they're being driven across the whole patch. The store footprint, kiosks, the new arrangements with supermarkets are going well, and obviously the online, which saw has seen no decline even in the reopening. It's still
one of those businesses that is obviously excellent demand, and it's the only issue they've got is opening enough for them. They've just got to find, and they've got, like, the franchise model is, like you say, it's probably worth explaining that to people why that's good for shareholders and why it's good for the cake box, the business, because, like I say, it's capital light, isn't it? I mean, when you got people queuing up to take these franchises, it's so good, isn't it?
Yeah, I mean, they're at the record level of deposits, I think, if I remember. I can't remember the exact number, but it's the highest level of deposits they've taken from new franchisees. And the reason why it's a low risk opportunity for a new, sort of entrepreneur wanting a cake box franchise is that, they can make a good return in about 12, I can't remember how many months it is, but, on a payback basis. Once it's done that, they're making, sort of, I think it's about 90,000 pounds of EBITDA per store. And it's a proven model that's got great sort of, like, it's getting increasingly brand recognition. So it works for people, entrepreneurs wanting to put capital and sweat into the actual business. And it works very well, obviously, for Cake Box itself, because they haven't got to put the capital up front, and they can then do the strategic, expansion on that. So, I mean, the sales...
Selling business is a very risky thing. If you can make cakes, that's not a business, a lot of people can make cakes. Now what you have to do is have market them, of all the business set up, the locations, all that stuff. And that's why it's good for franchise. They got, like I said, a blueprint there of a successful business there. And I
mean, 2 years, I was just running actually 2 years ago, they had 32 franchise deposits. They've got 62 at the end of September. I mean, it's just as an absolutely fabulous sort of business model. And the thing is, just I mean, you must have got the same vibes. Suk Chamdal is so passionate about this business. He started.
But they fit their roles, because he's a CEO. CEO's got to be a bit salesman. They've got to be a bit excited and passionate, and yet a CFO there's relaxed, calm. He's a figures man. He's a bit calmer. But I like that. Yes,
and just when it comes to sort of valuation, with Cake Box, the shares have obviously run well of late. But I still think that, if you look at it on a 5-year perspective, I could easily see the shares go well over, £6.50. In fact, I've got my theoretical share valuation is 675. So lots and lots of upside. And likewise with Avingtrans, I've got a conservative valuation of, I think it's £5.26 or something like that. And it could go a lot higher than that, because that's got very little value for the Magnetica division. That's more for MRI. A couple of other ones which have been knocking the ball out the park. And luckily,
we've got 3 minutes. We got to go for it.
Okay, well, one equals. Okay, and I know you didn't get a chance to speak to Ian Strafford Taylor, but frankly, I mean, their sales were 30 quarterly sales for Q3 were 33% on a sequential basis, and they were 47% above pre-pandemic levels. And these guys do international B2B payments and corporate banking specialists. And I mean, that whole model is that end-to-end service is really flying right across all their services with their sort of one-stop shop approach. And particularly now being driven by this new sort of multi-currency service for larger corporates as well. So they're doing a fabulous job, and I think those
it's not going to get less busy, that sector, is it? It's just like it's going to pick up.
Exactly. And also, looking at the consumer when it comes back in terms of traveling for holidays, these guys haven't seen
starting now, isn't it? Because you got the test now, the
half-term
test and all that.
And you'll get a huge operating level. So I've leveraged. So I've actually increased my valuation now to £1 a share. I did notice that the broker hasn't changed their number. So when they do, you're going to get an upgrade, I'm sure, from their.
They're just copying your notes, Paul. Neil.
Exactly, Canaccord.
Yeah.
Canaccord. And I would say, just coming back to Cake Box, was that the Shore Capital, their broker, has got a really conservative revenue for the second half, given what they've just done in their first half. And I think they're going to blow through those numbers as well. So, you know, you've got both of those business where I think we're going to see upgrades, you know, going forward. And just finally, but there is another one, which I was just trying to remember which one it was, which I wanted to talk about. Yes, Manolete, which is basically the UK's #1 insolvency litigation funder, third-party funder. I mean, frankly, again, they came out with a fabulous sort of like encouraging half-year trading update saying, yeah, they're starting to see a lot of activity in September because the government now has lifted its restrictions on creditor protection for medium and large-sized companies, and that means companies are going to go into insolvency, which should have gone into insolvency over the last 18 months. You'll see that whole sort of like backlog of cases come through, and they will benefit from that. And my daughter works into this space, and she's already, I mean, she's seeing that coming through. There's a bit of a lag to go to Manolete of about 3 to 6 months. So I think we're going to see more encouraging news flow coming from the guys later on in the year.
The chart is looking good, though. I mean, it's starting to pick up, and it's above the moving averages. It's now starting uptrend in that chart, looks like.
I think they're going to have an absolute blockbuster, you know, next year, in their next financial year, because you're going to see all that sort of unwind. And I've got my theoretical price for that is £4.60. And I think, I can't remember what the shares are, 320, 330 or something like that. So the guys are doing a terrific job. They've been through the mill a bit during the pandemic, but are doing really well. So, you know, there's lots of good stocks to have a good look at.
Do some research there, and like anything, there's so much choice there. But I think sometimes things that interest you, you know, start with that and then start researching, you know, and because there's always opportunities in the market, and there's lots there that have been highlighted. Marvelous stuff. Thanks for that, Paul. And we'll speak in about a couple of weeks' time. Thanks very much.
Yeah. Cheers, Justin.